Hey guys, I want to talk about a trade that I put on today. It is August 12th, 2015, and this trade that I made, it's a trade that I've paper traded many times. I've been experimenting with this strategy, but I've never officially done it. Well, today that changed. I bit the bullet and put this trade on for real with real money for the first time. So what it is selling strangles. A strangle is when you buy different strikes on either side of the option chain. So for instance, if stock XYZ is at 50 bucks and you think it's going to make a big move up or down, you would buy the 48 strike put and the 52 strike call. That is a strangle. Well, what I did is I sold a strangle. I collected premium as opposed to paid premium. And the trade I made is I sold the Apple August 28th 107 by 124 strangle for a credit of $1.08. So I collected $108. I sold one contract of each. This is how the position looks in my portfolio. You can see that I am short the August 28th 107 put at 78 cents. It had quite a bit more premium on the put side than the call side, and I am short the August 28th 124 strike call at 30 cents. So 78 cents plus 30 cents equals $1.08. So that is what creates my credit. And this is how I entered the order for those of you who are maybe looking to do something similar in your portfolio. Not that I'm advising that, of course. But so this is what it looks like. I sell to open both sides. And what I'm doing here is I'm betting that Apple will be between 107 and 124 at expiration. Those are the two strikes I'm trading. So the best case scenario for me is if Apple stays between 107 and 124 over the next couple weeks, or really all I need is that on August 28th it is between 107 and 124. So I collect the premium, so the value shows up as a negative number, similar to the way that shorting a stock would appear. So now if the trade ends up working out and I want to close the position, I just buy to close both sides. And I want to buy to close the total spread for 34 cents or $34. And if this order fills, my profit will be 68%. You get that by just subtracting 34 from 108, which equals 74, and then divide 74 by 108, which equals 0.685. So that is my total profit would be 68%, and there's actually a typo here. I said the actual dollar profit would be 68 bucks. It would be 74 bucks. And so that's what I stand to make on this trade, and this is how you enter it. You then buy to close both sides, the August 28th 107 put and the August 28th 124 call. It doesn't matter how this gets to 34 cents. Any combination where these two strikes equals 34 cents will allow me to cover the position. So that could be Apple might be at 110 and the 124 call is completely worthless, and the 107 put has a little value on it and it adds up to 34 cents. Or maybe the Apple on August 26th is at 122, so the 107 puts are worthless, but the 124s have a little bit of premium. They equal 34 cents. Again, doesn't matter how it gets to be that combination. At whatever time these two equal 34 cents, which is what I'm hoping for, I will be able to cover it. Why do I cover at 34 cents even though I think the position will expire worthless? Well, because you never know. And I'm capturing 68% of my profit. Doesn't make sense to me to hold for the additional 30% where my risk is still, unlimited in theory, and more on that in a second. So what's my break even here with this trade? How do you calculate that? Well, it's quite simple. To calculate my break even, I add or subtract the $1.08 I collected to each side of the strangle. So for example, I shorted the 124 call. You would add $1.08 to that, which means my break even on the short side of the call is 125.08. 124 plus $1.08 equals 125.08. On the long side, the 107 put that I shorted, you would subtract 108 from the 107 strike, which is $1.05, 105.92, $105.92. So if Apple is between 105.92 and 125.08 at August 28th expiration, I will be guaranteed to at least break even. If it goes above if it's above 125.08, then my losses are unlimited to the amount that Apple rises. For example, if it goes up to 130, and that's where it's trading on August 28th, I will lose $4.92. 130 minus 125.08 equals $4.92. So my loss would be $492. If Apple's below 105.92, my losses are unlimited to the amount Apple declines. For example, if it is at 100, I will lose $5.92 or $592. So, that's kind of scary, right? I mean, my losses are theoretically unlimited. Apple could drop to $90 and I get wiped out over the next 2 weeks on that, or it could rip higher to 135 over the next 2 weeks and I could get killed on that. But I don't think that's going to happen. From today's close of 115.24, Apple can rise 7.6% or fall 7.1%, and I will still make max profit. Apple can rise 8.5% or fall 8.1%, and I will still break even. I like that range. I'm giving myself a really wide range to profit in. This is a bet on volatility decreasing. Apple has traded in an 8% range for 2 consecutive weeks for the first time since 2012. I'm betting that the next 2 weeks will not see similar volatility. Keep in mind, Apple could trade in a 5% range next week, which would still be an incredibly wide range, but this trade would still work. As long as the volatility is not exceeding 8% over the next 2 weeks, this is going to be a great trade. So it's a risky trade in terms of potential losses, right? Theoretically, unlimited losses. Apple could go to $200 and I'm short here, or it could go down to $50 and I'm, shit out of luck. But to me, it's a low risk trade in terms of probability. What are the odds that something like that is actually going to happen? The options market right now is pricing in a 6% chance of one of the legs of my strangle finishing in the money. Furthermore, I would be comfortable being assigned 100 shares of Apple long at 107, because that's what would happen if I was in the money, if I didn't choose to close it out, if that's where the stock is in 2 weeks. If I was wrong to the upside, if Apple was stronger than I'm expecting it to be, if it's up near 130, or on the way up to 130, then I'll probably just look to cut my loss. So bottom line though is this is a bet that Apple isn't going to be as volatile as it's been. It's a bet that if it does go down, it's going to have support, underneath 110 in the high 108s, 109, somewhere around there. And it's a bet that the recent breakdown beneath 120 is going to make it hard for the stock to rally back up, towards 125. So if we just look at the chart here, these two thick lines right here represent my break-even range. Again, 105 to about, or it's about 106 to about 125. And, this is a weekly chart, by the way. So what I like about this is the 105, 106 range is in line with the lows for the year. I think Apple's going to have support. It'll have buyers at those lows for the year if it does go down there. And again, that gets back to my point about being comfortable being assigned 100 shares of Apple long at 107, where remember my break even is 105.92 on it. That would be the cost basis on the shares. Well, the cost basis would be 107, but because I collected $1.08, that would be my real cost basis. All right, so that's why I'm comfortable being assigned shares down there. If it wants to get there in 2 weeks, I think Apple would bounce off of that. And then as to the upside, I think you got a lot of trap money up here from this long channel where you traded between 125 and 135 really for much of the year, from February up until mid to late July when we just suffered that recent breakdown. So I think over the next 2 weeks, if it does bounce, from 115 on up to 125, and ideally it doesn't get past 124 since that's the strike I shorted, we're talking about an 8% bounce. And I think Apple would have sellers into an 8% bounce. You'd have people that bought down here that are locking in profits, and I think you'd have people who didn't sell back here during this consolidation, looking to reduce their exposure given the volatility it just saw. So bottom line, I like the trade. I feel good about it. And this is a different type of trade. Again, I've never made it before, but it's a good trade for if you're not sure which way the stock's going to go, but you're pretty sure it's not going to keep trading in extremely wide ranges. You know, maybe you don't want to buy calls here because they're juiced up right now. Implied volatility is pretty high for Apple, so you don't want to own premium, but maybe you don't want to sell a premium exactly because, you know, it's been so volatile that you're kind of scared. Well, I'm selling premium, but I'm selling it with high probability odds of success, and I'm selling it on both sides so that, you know, as long as the drama kind of dissipates and it doesn't make another huge leg down towards 105 or a huge bounce back up towards 125, this is going to be a profitable trade. The best scenario will be if Apple just kind of starts going sideways here somewhere in this range over the next 2 weeks. I'm going to get that premium to come out and I'll be able to cover it at my target. So hope you got something out of this. Hope maybe you learned something new. Again, this is not advice to make this trade, just simply sharing my thought process and the trade itself in an effort for you guys to learn and maybe get some of your own ideas.